If you're looking at the crypto charts right now, you might be thinking it's all over. Everyone seems to be saying the party's over, the market is dead. They're pointing to falling prices and telling you to sell. But what if they're all looking at the wrong data? What if, hidden beneath the surface noise, there are powerful signals the mainstream is completely missing? These signals don't just point to a recovery, they point to a 2026 crypto supercycle that could dwarf everything we've seen before. Today, we're looking past the headlines at three signs that top macro investors are watching. And it's not based on hype, it's based on data. The first and most powerful sign is the massive shift happening in the global economy. For the last couple of years, central banks, led by the US Federal Reserve, have been tightening the money supply to fight inflation. That makes borrowing expensive and pulls money out of assets like crypto. But that chapter is closing. The Fed has been winding down its tightening program, and market expectations for rate cuts are high. When interest rates go down, money gets cheaper. Investors start hunting for higher returns, and that capital naturally begins to flow into assets like crypto. And this isn't just a theory. We saw this exact pattern play out from March 2020 to April 2021, when central banks pumped massive liquidity into the system. During that time, Bitcoin didn't just go up by 500%, it surged by nearly 900%, rocketing from around $7,000 to over $64,000. Now, analysts see a similar setup with monetary stimulus expected to support growth well into 2026. This creates what some are calling a liquidity flywheel, a perfect storm that could propel crypto to new highs. This macro tidal wave is the foundation the next supercycle will be built on. The second sign is the single biggest change from every previous crypto cycle: the kind of investor showing up. Past bull runs were mostly driven by retail investors who were already deep in the crypto world. This time is different. A seismic shift is happening as institutional investors finally enter the space at scale. We're talking about hedge funds, banks, and pension funds. The launch of spot Bitcoin and Ethereum ETFs created a regulated and familiar front door, drawing in traditional players who were once forced to stay on the sidelines. A 2025 survey from Coinbase and EY Parthenon found that over three-quarters of institutional investors plan to increase their digital asset allocations. This isn't just a prediction, it's a structural transformation of the market happening right now. We're seeing a clear trend where major banks are building out crypto services, something that would have been unthinkable a few years ago. Corporations are starting to see the logic of holding a small percentage of their treasury in Bitcoin to hedge against currency devaluation. The game has completely changed. The previous cycle was about crypto natives. The 2026 cycle will be defined by the nearly limitless capital of traditional finance finally stepping into the arena, providing a level of stability and sustained buying pressure the market has never seen before. The third sign is the explosion of real world utility being built on the blockchain, specifically through something called tokenization. For years, crypto was often called a solution looking for a problem. That's not the case anymore. Tokenization is the process of converting real world assets like real estate, private credit, or commodities into digital tokens on a blockchain. A report from Boston Consulting Group and ADDX projected that the market for tokenized assets could become a $16 trillion opportunity by 2030. The market for these real world assets already reached $24 billion in 2025, a massive increase from previous years. Stablecoins are the critical payment rails making this new digital economy possible. At the same time, the core protocols are evolving. Ethereum's Pectra upgrade, which went live in May 2025, dramatically improved user experience and staking efficiency. Looking ahead, the Fusaka upgrade, expected in late 2025, is set to further boost scalability and lower transaction costs, attracting even more users and developers. This isn't just about faster transactions, it's about building a fundamentally new financial system on chain. 2026 is shaping up to be the year these technologies hit critical mass, creating real value that goes far beyond speculation. So, let's put it all together. You have a massive wave of global liquidity waiting in the wings. You have a completely new class of institutional investors with deep pockets entering for the first time. And you have the underlying technology finally unlocking real world use cases. While the daily charts might look scary right now, with Bitcoin recently dropping below $85,000, the long-term data tells a very different story. While past cycles were volatile and driven by retail hype, these three catalysts point toward a more sustained and powerful cycle led by institutional capital. It's why some analysts are calling for Bitcoin to potentially reach prices of $100,000 or even $200,000, and for Ethereum to target the $7,000 to $9,000 range. These trends are unfolding as we speak. The smart money isn't getting spooked by the headlines. They're watching the fundamental shifts. If you want to follow this story with us and stay ahead of these powerful changes, hit that subscribe button for our ongoing data driven analysis.